Welcome, everybody. Welcome here to the Nuffield Foundation and to this event on the research undertaken by a brilliant team at the IFS on what drives how much workers are saving in their pensions. I'm Alex Beer and I'm Welfare Programme Head at the Nuffield Foundation. We're delighted to have funded this important research that was initiated by Rowena Crawford and undertaken by Carl, Jonathan, Heidi and Lawrence. A huge thank you to them all who will be responding today, and thank you to you all for joining us here. The Nuffield Foundation's mission is to advance social well-being. We do this by funding research and analysis in the areas of education, welfare and justice to help better understand the issues affecting people's life chances and the trends and disruptive forces that are changing people's lives. It is our aim that the research that we fund informs social policy and ultimately makes a difference to people's lives. Through our welfare domain, we fund research, analysis and development projects relating to people's welfare or well-being at all stages of life and how vulnerability to adverse outcomes might be mitigated. Research on pensions naturally falls within this framing of looking at all life stages, as by their very nature, pension incomes reflect labour market outcomes and decisions made across all stages of adult life. And on International Women's Day, as the gender pay gap bot works overtime, you may even be wondering how inequalities in pay and hours worked translate into pension outcomes. Well, wait no longer for these new findings on pension savings behaviours at different ages of men and women, and the self-employed, which we funded for the insights it might provide into further policy or practice change that might address people under saving for retirement. Over to you, Carl.
Thank you, Alex. So my name's Carl Emerson. I'm a Deputy Director at the Institute for Fiscal Studies. We'd like to thank the Nuffield Foundation for funding this big programme of work that we've been doing over the last couple of years and for hosting today's event. What we'll be talking to you about today is the final set of outputs from this research, 3 pieces of work that we've published over the last week or so, all of which are looking at the drivers of private pension saving decisions. So the structure for today is, first of all, we'll have Jonathan presenting on employees and their pension behaviours. Then Heidi will talk about the self-employed, very important group where some big challenges remain. And then finally, Lawrence will talk to you about the women's pension, the gender pension gap. And after those 3 presentations, we'll hand over to Tom Josephs, who's a director at the Department of Work and Pensions, who's joining from Sheffield, to give their response before we'll have a question and answer session. So I'll hand over to Jonathan, who's going to give the first presentation.
Thank you, Carl, and thank you, Alex and Nuffield. So the set of reports authored by Heidi and Lawrence and I, we're going to go through them one at a time, and I'm going to start today with our work on when and why do employees change their pension saving. So we all know that automatic enrolment has boosted pension participation, but many are only saving very low minimum amount. I feel like I'm doing something wrong with the technology. I don't know is it okay in the back, or if not, okay, fine. But many are likely to need to save more. But it is important to think about when people should be saving more, in addition to how much. And that's for, I think, 2 broad reasons. One is that there might be parts of the life cycle when it's easier for people to forego current consumption in order to push back financial resources to their retirement. And indeed, if you're thinking about how to encourage extra saving, then it might be better to encourage it, or easier to encourage it at those points of the life cycle. So in general, we might think that it is better to save more in a pension when your earnings are higher, when you have higher tax incentives to put money into a pension, when your consumption needs are lower, and when you are saving less for retirement in other forms, because of course pensions are not the only financial assets that people hold. And so we're going to look at a set of factors that could potentially be driving pension saving, or at least have a rationale that people should be saving more at those particular points of their life cycle, and draw out, and based on what we find, then draw out further lessons for policy. So broadly, I'm going to be talking about these points here, at the bottom of the slide, when people get pay rises, what people's tax incentives are, and a set of life events that might change what your consumption needs are or what other saving you are doing. So this will be, therefore, a little bit of a whistle-stop tour. I'm happy to take more questions on any of it in depth later. But I'm going to start with thinking about how people getting a pay rise affects their pension participation and contributions. And what we do here is, using detailed government data on employees and their pension savings, we take the same sets of the same people and follow them as they get changes in pay. And then based on those data, we can look at whether they are more likely to join a pension as their pay changes, or indeed leave a pension as their pay changes. So this chart I'm going to show you thinks about what is the effect of a 10% pay rise on whether they join or leave a pension, and how that differs for people at different points of the life cycle. So the broad findings here is that pay rises create small increases in the probability of joining a pension for people in their 20s, but basically nothing at later ages, and that pay rises discourage people from leaving pensions. Now, maybe that's not overwhelmingly surprising, but really the fact is that these are not particularly large magnitudes on whether you're coming in or out of a pension. I should say these are from 2019-20, and therefore automatic enrolment is in place at this point, and these numbers are a little bit smaller than what you saw before automatic enrolment, but really not dramatically so. So that's on the participation side. What about how much people are putting into their pensions in terms of kind of their percentage of salary? And so again, looking at a 10% pay rise, what happens? Well, here, the axis is going to give you a clue to the fact that the effects aren't very big, because this is 10% pay rise, and do you put 1 percentage point extra in your pension as a result of a pay rise? That would be if the bars are going to reach the top there, say going from 4 to 5%. But that's where the effects are at the bottom. I don't know even if you can see them at the back. They're all below 0.1%. So really not much happening there at all. And I think, I'll come back to reflect on this at the end, but, in general, I think that when thinking about suitability for saving for retirement and the resources people have in later life, really I think that most people would like these numbers to be a bit bigger in terms of getting people saving for later life. So that's the work we've got on pay rises. What about tax incentives? Well, there are various tax incentives for saving for retirement, and indeed we put out some work earlier this year thinking about a potentially more rational system for taxation of pensions, in our view at least. But I'm going to focus, and we have in our reports, on just one particular tax incentive, which is around the higher rate threshold. So under the pensions tax system, there is a higher incentive to save the higher your marginal tax rate that is faced by individuals. And there's a notable change in the income tax system at the higher rate threshold when the marginal tax rate goes from 20 to 40%, giving you a higher incentive to save just above the HRT. So, are employees more likely to save in a pension just above the higher rate threshold when they face this higher tax incentive? Well, I can show you this in this graph. So this basically takes some data from various years and normalizes it around the higher rate threshold at 0 there, that vertical line. And this is data then on from 2005 to 2012 on the workplace pension participation. And what you can really see there is that there is no dramatic change, or indeed any change at all, in pension participation at the higher rate threshold. And while once you take some data after automatic enrolment has started, or been fully implemented at the end of that data, 2019, the levels are higher, but again, no tick up in participation when the upfront tax incentive increases. So my answer to that is no. What about contributing more to pensions above the high rate threshold? Well, we do find some effects there, at least before automatic enrolment. So before automatic enrolment, we think that there were statistically significant but economically modest impacts of about £150 per year extra contributed to a pension for a typical employee close to the higher rate threshold. After automatic enrolment, we bring more savers into pension saving, potentially make them more kind of inert, less responsive types of savers into automatic enrolment. We no longer find anything at all. Now, my presentation is about employees in general, but we have actually done this same set of analysis looking at changes around the higher rate threshold for the self-employed as well. So I am going to show you that, and it's important to think about that because while the self-employed have lower pension saving rates, they don't have automatic enrolment, and they do have potentially more flexible pension arrangements than employees. So are the self-employed more likely to save in a pension above the HRT? Well, I basically have the same graph here, looking at how income compares to the higher rate threshold. And I have the tax data that Hayley's going to talk more about. And what we see there is some actual differences. We do see a jump up in pension participation around the higher rate threshold for the self-employed. There are some differences in types of people just above and just below, and when you kind of control for this, it looks like about an extra 3 percentage points of pension participation on a baseline of about 40%. So that jump up is happening as a result of the tax incentive at that point. So that's fairly modest, but it's clearly a massively bigger impact than on the employees. Do the self-employed contribute more to their pension? Again, it's actually a similar story to employees, where we kind of have statistically significant but economically modest impact of £100 a year, although on a baseline of very low levels of saving per year. So the last bit of analysis that I'm going to talk through is how different life events affect pension saving. I mean, life events is a slightly funny word, but it really means changes in circumstances in people's lives that we think could, potentially have an impact on their pension saving. So the things that we're going to be thinking about are changes in housing tenure, whether you bought a house, whether you're moving from, out your parents' home, in and out of renting, for example, whether you have children, when children come along, and whether your partner moves into work. We also look at kind of getting married and divorced, but those can change. I won't focus on that just because the changes are less obvious or what you might expect to happen. But in general, we might either expect or indeed hope that pension participation contributions would rise at the points, at these particular life events that make it easier for them to save for retirement. So, for example, when you have your mortgage paid off and you don't have a few £100 or more per month going to the bank, when you move from renting to owning a home, that's generally, at least up until the last 9 months or so, based on interest rates, led to a fall in your consumption needs when your kids move out or when your partner gets a job. These should all make it easier to save for retirement. On the other hand, when kids are born And when you move out of your parents' house, potentially to renting, that might be a point that your pension saving could or should fall. So looking at changes in employee pension contribution rate, expressed as a fraction of pay, I then here show you, on average, in understanding society data, how these life events correlate with changes in employee pension contribution rates. So the thing to note here, I think, is a couple of things. These are various life events. None of these show massive increases. This is just purely descriptive. But, you know, it does kind of stand out that maybe living with parents, moving to rent is reducing pension contribution. Maybe the having a first child are. But the difficult thing about this is if you look at these carefully, a lot of these life events are going to be correlated with each other. There's particular points of life when you are likely to potentially buy a house, maybe have kids, maybe your partner is going to move into or out of work. A lot of these things might happen, say, between the ages of 25 and 35, depending on who you are. So we need to control for all the different things that are going on in people's lives and then think about how that affects pension savings. So once we do that, basically nothing seems to affect pension contributions except for two life events. And one is when you are moving from renting to owning a home, you are more likely to increase your pension contributions. On average, we think about by about 0.4% of pay. And on the other side of the ledger, when your first child is born, I should say, pension contributions tend to fall relative to expectation by 0.3% of pay, and that effect it seems to be bigger on women than on men, and that's even kind of conditioning on the fact that they are kind of still in work at this point. Clearly, Lawrence will come back. The issues around having children and gender inequalities is clearly something that's going to be very important for the gender pension savings gap that Lawrence will come back to. So I've really given you quite a lot of information, hopefully, there. And so I want to kind of now just reflect for a couple of slides on what I think the kind of things that we can draw out in terms of implications for policy. So the kind of theme running through this presentation is that there aren't substantial responses to earnings tax incentives or life events that could or should potentially encourage people to save for retirement. That's particularly the case since the introduction of automatic enrolment, and people are highly driven, both in this literature and in others, by default options. It does look like tax incentives alone are not enough to encourage additional saving. Clearly, you know, this evidence shouldn't be taken to mean that there shouldn't be a system of some subsidies for pension saving. I think that there are some cases for that. But in terms of if you're looking for extra policies to encourage additional saving, it doesn't look like that's where you would want to be heading necessarily to get most purchase on this problem. I think that there is a good case now for higher default employee contributions at higher levels of earnings, given we have a system where there are where people are automatically enrolled and there are these minimum defaults. It is right to question whether those should be exactly the same for everybody, or whether there is a case to encourage in some form of auto-escalation, for example, higher minimum contributions at higher levels of earnings. I guess the case is, it seems to me, particularly strong above the higher rate threshold, because because if you are encouraging people to save, put more of their pension money in their pension at that point, they do not have to forego as much current consumption at that point. I think more broadly, we should think about whether it's possible to encourage or nudge employees into being more responsible to life events. One way of doing that could be to use things that are correlated with life events that might mean that you should save more for retirement. So I think it's fair to say that one way you could do this is think about whether there are particular age thresholds beyond which you want to encourage higher contributions conditional on earnings. Above the ages of 50 or 55, it's more likely that people have mortgages or in the future student loans paid off and children to have left home. So you could potentially use that as a way of going about this. It's also worth thinking whether there are more direct ways of targeting changes around these life events. Is it possible to encourage people to divert a share of their mortgage payments into a pension scheme, or to integrate information on student loans that happens through payroll to automatically increase contributions when the loan is paid off? Very interested in getting any of your thoughts on those. But I think for now, I will now kind of leave it there for employees and hand over to Heidi, who's going to tell you everything you didn't know about the self-employed, hopefully.
All right, thanks very much, Jonathan. So I'm going to be talking about pension saving of the self-employed today. And I'm just going to start with a bit of context here. So the number of self-employed workers in the UK grew very rapidly in the last couple of decades. So back in 2001, we had about 3.3 million people who were self-employed in the UK, and that grew up to 5 million by 2019. Now, we do think that that number has come down a little bit since then, but we still have about 1 in 7 workers in the UK who are self-employed. So it is a very significant minority of workers. The self-employed differ from employees in a number of ways. So on average, the self-employed have lower incomes, but also the share of very high earners is higher among the self-employed than it is among employees. Also, their incomes tend to be more volatile. You know, self-employed people are less likely to have these monthly paychecks that most employees have. The industry composition among the self-employed is also quite different to employees. So, for example, among the long-term self-employed that I'm going to be looking at today, more than a quarter of those workers work in construction. The self-employed are also on average older, also more likely to be male. So again, about more than 2/3 of the long-term self-employed that we'll be looking at are men. And you know, what we're going to be focusing on today is they have much lower rates of private pension participation than what we see among employees. So today I'm going to be presenting our analysis on pension saving patterns among the self-employed using administrative tax data. And I'll talk you through the data now a little bit. So in this analysis, we're going to be using administrative tax records, so the self-assessment records from HMRC. And this is the first time that this data is being used to look at this exact question of how the self-employed are saving for a pension. You can see here that the data that we have available goes from the sort of mid-2000s to the mid-2010s, so that is a bit of a disadvantage that we only have that period of data. But there are a lot of advantages and benefits to this data set as well. So in this data, we have close to the whole population of the self-employed people in the UK. We can follow the self-employed workers over time for every year that they are putting in a self-assessment tax return. And we have these detailed measures of annual income and annual pension contributions in the data. And today I'm going to be focusing on a specific sample of the self-employed. So we're going to be looking at self-employed workers who've been self-employed for at least 5 years, and then they're only self-employed, so they have no employment income. And the reason why we're focusing on this particular group, who do make up about a half of the total population, so it's not a small group, but the reason why we're focusing on these people is that, you know, those of the self-employed who spend large parts of their career in self-employment, they will then rely on the saving that they've done during their self-employment years in retirement and with their retirement resources. So, whereas if someone kind of dips in and out of pension self-employment, we might think that they also have an employer pension available to them, and we might worry less about those people. But I'll start by talking about the private pension participation among the self-employed. And again, for context, we know that among private sector employees before 2012, so the introduction of automatic enrollment, we had been seeing this decline in private pension participation. That trend was then reversed with automatic enrollment. But from survey data, we also know that the private pension participation among the self-employed was falling at a much higher or faster rate since the late 1990s. And because the self-employed are not subject to automatic enrollment, we've seen a continuation of that declining trend since 2012. And now we can add the tax data in here. So what we see here is that that when we're looking at the self-assessment records, the private pension participation rates among the self-employed are even a little bit lower than they were in the survey data, although the kind of rate of decline here is very similar both in the survey data and in the tax data. But the question is, of course, why is it that the self-employed are saving such, or so few of the self-employed are saving in private pensions? Now, the kind of explanation that sometimes people have offered is perhaps, we know that the self-employed on average have lower incomes. We know that having a lower income is sort of associated with lower probability of private pension participation. So perhaps it's the differences in the incomes of the self-employed and employees that might explain some of these differences in overall participation rates. But so what I'm doing here is I'm plotting, and I'm showing the private pension participation rates of employees and self-employed of different income levels. So first, looking at the solid dots or the closed dots, we can see that, so that's showing private pension participation rates of employees and the self-employed in 2011-12. So that's a period before automatic enrollment. And we can see that among people earning about more than about £15,000 per year, the private pension participation rates among the employees of similar incomes are very much higher than they are among the self-employed. And we can see that when we're looking at a later period, which was after the introduction of automatic enrollment, this gap has really opened up even more. So, if you're looking at, for example, a self-employed person and an employee earning about £20,000 per year, the gap in the private pension participation rates between these two groups is about 43 percentage points. And that sort of gap is also there even at £40,000. So among the self-employed and employees, this gap is very persistent and at most levels of income. So it doesn't look like it's just about incomes where the reason for these gaps between pension participation rates of self-employed and employees. Now, another thing that we sometimes hear is that, well, maybe because of the volatility of self-employed incomes, it's the self-employed, the way that they save into a pension is that in years when they have a good income year, they move into pension saving, and then when they have a bad income year, they sort of stop saving. So we tried to look at this with the data that we have. Now, of course, because it's tax data, we can only look at movements in and out sort of year to year. But what we see, what this shows us that if we're looking at the proportion of people who in tax years start saving, so they went from not saving to saving, or a proportion of people who stop saving, these are very, very low rates. And it is really most people are not saving in either year. So, this and other pieces of evidence that we have in the report basically tells us that it doesn't really look like people or the self-employed people are moving in and out of pension saving and making these kinds of active decisions based on how their income is in that year. So that's some of the evidence on pension participation. And I'll now talk about or focus on pension contributions among self-employed savers. So only looking at the group of the self-employed who are actually saving in a pension. And I'll start by comparing, the contribution rates of self-employed savers to the contribution rates of employees who are contributing into a defined contribution pension. So what we find when we're looking at this, and if we start by looking at employees' own contributions only, the contributions as percentage of earnings among self-employed savers are actually on average higher than just than employees' own contributions in DC pots, and this is true across the income distribution. However, probably the more appropriate comparison here is to look at total contributions, so adding in employer contributions for employees, because that's actually the amount of money that is going into pensions for employees. And so what do we see once we add in the employer contributions? Well, still, for those earning below about £20,000 a year, it does look like the self-employed average contributions are higher than the average contributions among employees. But then when we're looking at incomes beyond that, the contribution rates do seem to be higher for employees, especially in the middle of the income distribution. So for example, if we're looking at the self-employed and employees earning about £45,000 a year, the difference in the pension contribution rates is about 4% of pay. So these are quite large gaps that we see in the middle of the earnings distribution. But what this sort of tells us is that there are these differences in average contribution rates between employees and the self-employed. So then we want to ask this question of, well, how do the self-employed seem to choose the amounts of money that they put into their pension? And we know that employees tend to choose their pension saving as a percentage of their pay. So, that means that if their pay increases, of course, then their sort of cash contributions that are going into their pension also increase, or vice versa if they see a pay decrease. But the pattern among the self-employed looks very different. So what I'm showing here is the distribution of cash pension contributions among the self-employed. And what we've done here is we've taken data across sort of 10 years and just looking at the cash amount in each year and then plotting the histogram of that. And basically the height of these peaks tells you what proportion of savers is contributing that amount in a year. And what can we say about these amounts, especially the ones that I've highlighted here? Well, we see these peaks at what I would call nice round numbers. And actually they're even sort of nicer and rounder if we divide them by 12. So basically, it looks like, at least based on this evidence, that a lot of self-employed workers tend to pick a monthly amount. So in this case, 30, 40, 50, 100, and so on pounds per month. Maybe they set up a direct debit, and then that's how they've chosen the amount of money that goes into their pension. And actually, if we try and look at, do we see similar peaks when we're looking at the incomes of the self-employed, we don't see that. So it looks like the link between earnings and the pension contributions among the self-employed is sort of weaker. And, when we're looking at this, and, the exact definition of what we mean by round numbers is at the bottom here and in the report. But we find that about a quarter of the self-employed seem to choose the amounts that they put into their pension in this kind of round number way. And actually, the most common amount is £600 or £50 per month. Sorry. So next, I want to then think about, well, how is it that these self-employed workers are changing the amounts that they save from year to year? And again, I'm going to be looking at cash contributions. So looking at changes in the cash amount or the nominal amount that goes into the pensions of the self-employed workers year to year. So now the sample is people who are saving first in 2 consecutive years, then in 1 year and 2 years later, 5 years later, and 9 years later. And what we can see here is that actually for most people, or for many people, or many of the self-employed, they do not change the amount that they put in their pension in cash terms. So if we're looking at people who are saving in 2 consecutive tax years, almost half of them are saving the exact same cash amount a year later. And even if we're looking at people who are saving over a decade, almost a quarter of the people who were saving initially are still saving the same amount 9 years later. And this really matters, of course, because, it might be that, well, you would hope that for some of these people at least, they would have seen some income growth. So, again, that link between their incomes and pension contributions isn't there. But also, if we're just thinking about inflation, in the period that we study, keeping your contributions in the same in cash terms would have meant about a 20% decrease in the real value of those cash contributions. But of course, that was also a period of relatively stable and low inflation. So now that we're in this very high inflation environment, that those falls would have been even larger. And finally, we can then put these two things together. So we can look at, well, taking the previous graph and looking at changes in pension contributions between years, but then splitting the sample between those who in the first year that they were saving, or in the first year that we observed them, were making a round pension contribution, or pension contribution in round terms, and those who weren't, we see quite a striking pattern. So among those who were saving initially one of these round numbers, 82% are still saving the same amount a year later. Whereas that's 39% for those who hadn't chosen their pension contribution amount in that way. And then if we're looking 9 years later, among those who had initially chosen this round number, who are still saving a decade later, 60% of them are still saving the same initial contribution amount, compared with 13% among those who hadn't. So it looks like, it looks like this evidence points to people set up a direct debit and then just leave it. So I'll just conclude now. So what this research that I've shown today is really illustrates once again is the kind of inertia and lack of engagement with pensions. So I mean, most of the self-employed never start saving in a pension at all, and that is really the key policy challenge. How do you encourage people to engage with the private pension system and start saving? But what I've also shown today is that even among those of the self-employed who are saving in a pension, we do need to think about the amounts that they are saving, because it looks like there are also many of those self-employed who make that initial active choice to start saving in a pension, then just become kind of passive savers again. Now, what could we do about those people in particular? Well, among these self-employed savers, some sort of form of auto-escalation might be a good way to boost pension savings. So in particular, when people set up a direct debit, maybe we should have a default where the amounts that they're contributing to their pension increase maybe in line with inflation or in line with some set percentage every year, so that we wouldn't have this kind of situation where people just keep the same cash contributions for a decade or more. But for meaningful change, both in terms of participation and contributions, I really do think that new innovations and how we could incorporate pension saving defaults, for example, in the tax system, really are needed. So that's it from me. And again, I'll be very happy to answer any questions during the Q&A, but for now I'll pass on to Lawrence, who will talk about the gender gap in pension saving.
Thank you very much, Heidi. So the final presentation of this event, I'll be talking about the gender pensions gap. Now, of course, there are good reasons for people to worry about gender inequalities at all points of working life and the life cycle. But the gender pension gap, while there's not one official accepted definition of it, generally refers to gender inequalities in incomes between men and women who are retired. And this gender pension gap has received increased attention in recent years, and there have been a number of policies suggested to try and target it. But of course, to evaluate the effectiveness of these different potential policies, it's crucial to understand what's driving the gender pension gap. And that's what we're going to be focusing on in this presentation. I'll start by showing you some stats looking at the pension incomes of men and women who are retired, before then moving on to looking at people of working age and looking at inequalities in their pension saving. And this really hints at a theme that will be running throughout this presentation, and that's that it's very important to be clear exactly what gap we're analysing, so which outcome we're looking at, and for which group. So in particular, Are we talking about gaps in pension incomes, gaps in pension participation, or gaps in pension contributions? And is that measured as a percent of salary or in pounds? And also, are we looking, which group are we looking at? Retirees or people of working age? And are we looking at workers or a specific type of workers? And all of this is going to matter for the story that we're going to be sort of seeing from the graphs. And I'll go through this throughout the presentation. So to start with, as I mentioned, I'll be looking at gender gaps in incomes for people who are retired, starting with the state pension income, for people who are above state pension age. So here what we can see, to start with, I've plotted weekly average state pension income for men and women who are born in the early 1930s. What we can see is that men have higher average weekly state pension income than women born in these years by about £40 per week. Then, as we start to look at generations who are born later and later, we can see that this gap starts to gradually close, and this is due to recent reforms to the state pension system, as well as generational trends in women's labour market behaviour. And in fact, by the time we reach those men and women born in the early 1950s who've reached the state pension age in recent years, we can see that this gap is almost closed. The gap is less than 5%. So that's the state pension, but of course many people rely on other forms of income for ensuring a good standard of living in retirement, especially in the UK. So when we turn to look at gaps in private pension incomes, we can see that the picture looks very different. The gaps are even wider and have not closed to the same degree. So when we look at those born in the 1930s, women have average weekly private pension income that's about 60% lower than men's. And then when we look at the generation born in the early 1950s, this gap is still 45%. So if we're thinking about gaps in incomes for those who have retired or reached state pension age recently, or who are going to reach state pension age in the near future, we're really thinking about these gaps in private pension income, not state pension income. But of course, private pension incomes are the result of a whole working life of pension saving. And so any policies that are trying to affect this should really be based upon inequalities in pension saving done for people who are working currently. And so that's the group we'll be focusing on for the rest of this presentation. So to start with, looking across all working age men and women, whether they're in work or not, we can see that there is a gap in pension participation with about 2/3 of men saving into a pension compared to just under 60% of women. Now, the first thing you might think is that fewer women are actually working than men, and this might be driving some of this gap. And indeed, actually, once we restrict our attention to just people who are in paid work, the gap almost disappears. It's less than 1 percentage point. But this isn't the whole story. Once we look within different people working in different sectors, actually some gaps start to open up again. So when comparing men and women who are self-employed, the pension participation rate of men is about 3.5 percentage points higher than the pension participation rate of women. And within private sector employees, the gap's almost 5 percentage points. So how do these gaps within sectors combine to leave us with a very small gap across all workers? Well, that's due to the differing labour force compositions of the female and male workforces. So in particular, about 15% of the male workforce is self-employed, compared to just 10% of the female workforce, and this is the group where pension participation is particularly low. On the other hand, almost 1/3 of women are working in the public sector compared to just 17% of men, and this is where pension participation rates are particularly high. And these two things combine to leave us with, together with these within sector gaps, to leave us with quite a small gap when looking across all workers, at least in terms of pension participation. What about the amount entering people's pensions, their pension contributions? So just focusing on people who are saving in a pension, and looking again across all workers, we can see that here there is a gap, while there wasn't much of a gap in terms of participation. With average totals, so that includes employer pension contributions of about £100 per week or slightly under for men, and about £85 per week for women. So that's 14%, women have 14% lower. Again, when we look within different sectors, actually we see there are bigger gaps in each of these sectors. So women's total average weekly pension contributions are about 1/3 less than men's, more or less, in all of these sectors. But again, we have these bigger gaps within these sectors than there are overall, because a high proportion of the female labour force is working in the public sector, where we have these really quite comparatively high contributions. Now, there is another labour market inequality that you might think is going to be driving this, and that's, of course, differences in earnings between men and women, which we know exists from the data. So what we're going to do now is plot this, but expressing contributions as proportion of total pay. And then we get a different story when looking across all workers saving in a pension. Women actually are saving, on average, a high proportion of their pay into their pension. So it's about 15% of pay for women, compared to about 12 or 12.5% for men. Looking within different sectors, we can see that for the self-employed, actually, it looks quite similar to what we see across all workers, with women who are saving in a pension saving a high proportion of their pay into their pension. But of course, women who are self-employed and saving in a pension is quite a small group compared to at least some of the other groups in this chart. There's a little gap in the private sector. When we look in the public sector, we actually see men have slightly higher average pension contribution rates than women, by about 1.5% of pay. And again, the fact that more women, or a high proportion of the female workforce, is in the public sector where we have these higher contribution rates is really what's driving this sort of gap on the left-hand side being in favour of women across all workers. So those are the sort of big picture differences in pension saving between men and women of working age. What we've seen really is that of first order importance are these differences in labour market experiences, so differences in employment rates and earnings, which are driving the differences in the amounts saved into pensions. And of course, these differences in the amounts saved into pensions today are going to be the key determinant of the gender gap in pension incomes for future retirees, of course, along with differences in any potential differences in returns that men and women experience. But we did also see that there are differences in pension participation and contribution rates when looking at men and women working in the same sectors. And so for the rest of this presentation, we're going to be digging into what are driving these differences. And this is particularly important because we often think of pension saving policy as affecting different sectors differently. So for example, automatic enrolment doesn't really apply at the moment for the self-employed. So when looking at employees, I'm going to plot this by age because we know that for many gender inequalities, the life cycle is particularly important. And looking at participation, we can see that in the public sector, there's really quite a small, or they have pretty similar pension participation rates at more or less all ages here. In the private sector, however, a high proportion of men are saving into a pension than women at all ages, and the gap widens with age. So for those in their 20s and maybe early 30s, there's a gap of about 2 to 4 percentage points, widening to more like 6 to 8 percentage points for those in their 40s and 50s. So now we're going to try and see what's driving this gap. So to start with, I've just plotted this same gap again, the difference between the dashed lines in the previous chart. So we can see it starts at about 2 to 4 percentage points, rising to 6 to 8 percentage points later in life. And then the first thing we can do is restrict our sample to those earning at least £10,000 per year. And the reason we do that is because the automatic enrolment, those earning less than £10,000 per year are not obliged to be automatically enrolled into their pension by their employer under automatic enrolment. Once we do this, we actually see that that already leads the gap to pretty much disappear. If anything, there's a tiny sort of gap in favour of women for those in their 20s and 30s. Of course, this isn't the only difference between men and women working as private sector employees, so we can also control for these other differences, such as differences in earnings, the type of firms people tend to work for, and their industry and occupation, to name a few examples. Once we do this and we start comparing men and women with similar characteristics, we see that this slightly shifts the gap in favour of women at middle and older ages. So if anything, when comparing men and women with similar characteristics earning at least £10,000 per year in the private sector, women are slightly more likely to be saving into a pension than men, but only by a couple of percentage points. But really the story here is that this automatic enrolment £10,000 threshold is what's driving the gap in participation rates in the private sector, together with the fact that fewer women are earning, or more women are earning less than £10,000, mainly due to part-time work. So that's participation rates. we can also look at contribution rates. So to start with, just plotting the raw difference in average contribution rates for male and female private sector employees, we can see that there are small gaps in favour of women, for those in their 20s to 30s, up to about 0.5% of pay or so. And then for those in their 50s, a gap opens up, again, a quite small one, in favour of men. Restricting our sample to those earning at least £10,000 per year doesn't really have a big effect on this, and that's because we're already looking at people who are participating in a pension, so automatic enrolment doesn't have that much effect here. But once we control for other characteristics, individual and job characteristics that we can see, actually we see that the gap again really becomes quite small at pretty much all ages. So we no longer see this gap in favour of women for those in their 30s and early 40s really, and the gap in favour of men for those in their 50s has become fairly small. So we think that these differences in earnings and other characteristics is really, again, driving these differences in contribution rates. What about other sectors? So in the public sector, we saw that to start with, there was actually very little gap in participation between men and women. When it comes to contribution rates, there is a gender gap with men having higher average total contribution rates than women by about 1.5% of pay. When we control for earnings and other individual and job characteristics, this does actually disappear to be pretty close to zero. So we can explain most of this gap. And we think the reason that this gap exists is due to the structure of public sector defined benefit pension schemes. In particular, these pension schemes have quite rigid contribution structures with higher contribution rates for higher earners, and men have higher average earnings than women in the public sector, so they are making these higher contributions. When it comes to the self-employed, there is a gender gap in participation, with men having higher participation rate than women by about 3.5 percentage points. This does shrink once we control for earnings and a few other characteristics, but it doesn't quite close completely, especially at older ages. When we look just at people who are self-employed and saving in a pension, actually women already have higher average contribution rates to start with. So to summarise what I've shown you in this presentation, while the gender gap in state pension incomes has been closing and has essentially closed for those who've retired in recent years, there are still large gaps in private pension incomes, and these are driven by a whole working career of different pension saving. When we look at people who are saving for a pension in working life now, the main determinants of the gender gap are differences in labour market experiences, so differences in employment rates and earnings. And we know from other research, as well as some analysis that we've done in this report, which I haven't had time to show you, and what Jonathan said earlier, that these particularly open up after women have children. I also showed you that it's important to account for the differences in sectoral composition of the male and female workforces, which offset some of these within-sector gaps in pension saving, in particular the fact that women are a high proportion of the female labour forces in the public sector and a lower share in self-employment compared to among men. And when we look at gender gaps in pension saving within sectors, this we can largely explain by differences in earnings. So it's still these differences in labour market experiences that are key for driving these within sector differences as well. So what does this all mean? Well, the fact that the gender gap in pension saving is largely driven by differences in employment rates, hours worked and hourly pay means that we can predict that the gender gap in private pension incomes will remain open for decades. And that's because we still see these labour market differences for all generations active in the labour market today, even the youngest ones. In addition, we think it really points to the fact that policymakers should see the gender pension gap really as a further consequence of labour market inequalities. So when we see these gaps opening up after women have children, we should think about the long-term effects of this, which last all the way into retirement. And if we're really thinking about targeting the root cause of the gender pension gap, it's possible that labour market policies might be better placed to target these than pension saving policies in particular. And really, if we do think about the role of pension saving policies, it's important to think about how these fit into the system as a whole. So we saw already that the gap in pension participation among private sector employees was due to the £10,000 threshold for automatic enrolment. But this doesn't necessarily mean we're advocating getting rid of this £10,000 threshold. There are some good reasons for many people earning less than £10,000 per year to not be saving into a pension. In particular, the state pension itself is already worth £10,000 a year, more or less, and there are other means-tested benefits available for those above state pension age. So that's all from me. I'll quickly hand back to Carl to introduce Tom Josephs, I think.
Yeah, thank you, Lawrence, and thank you, Heidi and Jonathan. So before we go to the Q&A, we're going to have a response from Tom Josephs, who's a civil servant at the Department for Work and Pensions, who's going to join from Sheffield. Hi, Tom.
Hello, hi everybody. So I hope you can hear me. Yep. Good. Okay. So I feel like I've been sort of revealed from behind the curtain or behind the PowerPoint presentation. I have been able to watch and listen, and thanks very much to the Nuffield Foundation for making the technology work. So I'm Tom Josephs. I've been Director for Private Pensions Policy at DWP for about 6 months. I am based in DWP's Sheffield office, which is why I couldn't be down with you today. But again, thank you very much to the IFS and the Nuffield Foundation for inviting me to take part in this. It's been really great for me to hear about these IFS papers, which I think really provide a set of really fascinating new analysis and evidence, and all of it is really very relevant to our current policy development programme, and I'll say a bit more about that. Before I do, I just wanted to say also, in DWP, we are really committed to basing our policy on comprehensive research, analysis and evidence. We have got a fantastic team of departmental analysts, but of course the work of the IFS and other researchers, including in the pension industry, have always played a hugely important role in developing our evidence base and will continue to do so. And I should say also, we very much look forward to engaging with the IFS on their recently announced pensions review. So I thought it'd be useful for me to use this time. I'll just speak for about 5 minutes to say a little bit about DWP's priorities for private pension policy and how this relates to the specific areas covered in the IFS work. So the Minister for Pensions, Laura Trott, set out her policy priorities recently on 30th of January, where we launched the next stage of our defined contribution pension reform agenda. And she talked there particularly about the challenges created by the transition from defined benefit to defined contribution pensions, with individuals now shouldering the responsibility for building their pension pot and the risks around this being transferred from employers to individuals. And addressing those challenges have driven the 3 pillars which the Minister set out as underpinning her vision for pension reform, which are adequacy, fairness and predictability. So on adequacy, I think we have a solid foundation through the combination of the new state pension and the success of automatic enrolment in delivering increased private pension saving. But we recognise very much that nevertheless many people are not saving enough for retirement, and the IFS work today, I think, provides a really rich new set of evidence on this issue. Complementing the IFS work, I was really pleased last week DWP published an updated report on the analysis of future pension incomes. It's an excellent, really comprehensive assessment of pension savings across different groups in society against different measures of expected retirement income, and would definitely recommend that people look at that. One highlight there is that around 2 in 5 people are still likely to be undersaving for their retirement against the Turner Review's target replacement rate. So this is a big priority for us. And to start to address this issue, one initial priority for the government is to deliver the recommendations of the 2017 Automatic Enrolment Review to expand AE to lower the age criteria for enrolment and remove the lower earnings limit, so people start saving from the first pound of earnings. And the government has just announced actually that it's supporting a private member's bill which received second reading last week and would provide the legislative powers to deliver these reforms in the current parliamentary session. I mean, clearly, though, there's thinking to be done about the future beyond that. The IFS analysis is really interesting in that context, including thinking about auto escalation and contribution rate increases as income rises, and whether there is potential for more default options and nudging people to save more at key points in their lives. On that last point, we are already been holding focus groups to explore timely moments for pension engagement. But, you know, it is the case today, our previous research, our own research on member engagement, similar to many of the IFS results today, has shown that engagement does remain low. I think, you know, one hope is that better technology could change this over time. The pensions dashboard, which we are working on, will be a really important new tool which aims to give people a much more accessible and user-friendly platform to plan for retirement and to understand their future retirement income. We did announce last week a delay to that programme, which is a very complex technical undertaking, but we absolutely remain fully committed to its delivery given the potential benefits it could bring. And very briefly, at the Minister's event that I mentioned in late January, we also announced a set of reforms to underpin the return on pension savings and to help raise pension adequacy through this route, and we'll have more announcements on those areas through the year. I wanted to say a bit about the issues highlighted by the IFS on gender pensions gap and the self-employed. So the Minister is very much committed to tackling the gender pensions gap. She sees this as a key priority and a key issue to address under her fairness pillar. So this report is really, really welcome and provides a really great set of new analysis on the drivers of that gap. And in DDLP, we've just announced that we will work with other departments in government to develop a better framework for understanding the scale and challenge of the gender pension gap. And that sort of cross-government approach really, I think, reflects the IFS findings on the importance of labour market inequalities to this issue. So we'll certainly be wanting to engage further with IFS colleagues on this work, and which we would hope to publish in due course, and want to use it as providing a platform for us to then develop policy to address this issue. And then again, very much agree with the IFS on the challenge around self-employed. Clearly a huge gap in terms of private pension provision, and we have been doing a lot of work on this issue. So with Nest Insight, we've recently published results of trials on behavioural messaging and saving mechanisms on financial digital platforms to test the role of those kind of tech-based nudges and the value of flexible saving. Building on this, we're doing some work with the UK trade body for business software developers to look at whether there's feasibility of building retirement saving solutions within software used by the self-employed to manage their money. We're also keen to explore hybrid saving vehicles, which might combine sort of accessible savings with long-term savings, so could preserve control for individuals in managing their short-term finances alongside saving for retirement. We've also been working with HMRC. We've inserted a digital prompt to maps pension guidance into the self-assessment tax return, and we are looking at using evidence from the work with HMRC and Nest Insight to build on this. So let me stop there to allow you to get into the Q&A. I hope that's helpful in just setting out some of our current policy agenda and how it links in with the issues that have been raised today by the IFS. And as I said, really look forward to working with the IFS and wider colleagues as we take this work forward. So thank you very much. I think I'm going to drop off the screen so I don't distract you from your Q&A now.
Thank you very much, Tom. Yes, so we'll now turn to the Q&A session. We've got bit of time for that. When I come to you, perhaps you will say who you are and where you're from, and then we'll put the question to Jonathan, Heidi and Lawrence. Gentleman here at the front.
Mohammed Amin, I'm a retired PwC tax partner, but Mohammed Amin, I'm a retired PwC tax partner, but I'm here basically just as a layman. On participation rate differences between the self-employed and the employees, unless I missed it, nobody mentioned what I think is the most obvious explanatory reason, which is that for an employee, there's a much greater incentive to be a member of, to pay pension contributions, because there are employer contributions which, apart from a few enlightened employers, if the employee doesn't participate, they lose completely the employer's contribution. So when I saw those big differences, 40%, etc., I wasn't surprised. It's a simple function of people behaving differently because they have different economic incentives.
Heidi?
Yeah, no, absolutely. I agree that that some of the employees have more of an incentive to save into a pension, because if they're not, then they're basically foregoing this the employer contribution most of the time. I guess what I would say to that is that we did see large gaps also before automatic enrollment, before there was this requirement for employers to make those contributions, and the fact that we still saw those big gaps there shows that there's probably something else going on as well. And the self-employed also do have the similar tax incentives to save into a pension. So if they are going to save in any way, then pensions is a tax advantaged way of saving. So I think it is still worrying, even though yes, it's not surprising that especially after automatic enrollment the gap has become bigger. The fact that participation rates are so low, and the fact that we saw the faster decline even before automatic enrollment, I think all of that is still worrying and doesn't kind of leaves some questions to answer there.
Yeah, it does feel like it's not a surprise perhaps that private sector employees have had their pension membership increase so dramatically as a result of automatic enrolment, but it's the fact that self-employed has been continuing to go down and down and down. Which is more the kind of open question as to why and what can we do about it if it's a problem. Heidi, yeah? Yeah.
Hi, Charlotte Moore, freelance journalist. I just want you to know that I am the person that you studied. I have only a self-employed income, and I have been self-employed for a lot longer than 5 years. So just building on what the last gentleman said, isn't the obvious solution, and one of the reason why you've had continued, there's no behavioural reason to do it. You haven't got an auto-enroll system, and you haven't got an employee contribution system. So how much longer do we have to dance around this issue before the government grasps the nettle, if Thomas is still listening, and actually have some incentive for the self-employed that matches the employee contribution, whether that's from the government or something else? And I mean, it's a very detailed presentation, but the elephant in the room is the whole thing just went to show the power of auto-enrollment and harnessing inertia in every single group that you studied.
Do you want to?
Yeah. Yeah. No, you can go. Yeah.
Okay, so, okay. Heidi will say more, but I think one obvious thing that some people might suggest, and I'm not saying it's necessarily you, might be, well, if there's no employer to make a match, then we can, the government can do so. I think the issue there is that we already have a tax system which for people essentially on equivalent earnings, once you compare it right, is already more in favour of the self-employed and encourage people in that way. And that, generally a tax system is going to be better if it's rather more neutral between these different forms of employment. And so, in a sense, you could have a system of which you did do that. It might solve one problem and exacerbate another. And that's just on the kind of employer, government stepping in where there's no employer issue. Heidi, do you want to take any other parts of that?
I was exactly sort of similar thoughts to Jonathan, that that there are already benefits that other benefits that the self-employed are getting.
Sick pay
Yeah.
have maternal cover, so I mean.
Yeah, no, absolutely. But so yeah, I take the point around that. I mean, I think the government does recognise that we do need some sort of automatic enrollment type policies for the self-employed, as Tom was telling us. And I think it is encouraging that they are trying to do that through the tax system, through these different kind of software that self-employed use and so on. But I think as I said, it's the fact that the self-employed are getting also the tax benefit of the or the tax. They also have a tax incentive for this pension saving. So I mean, I take your point, but I think there are these. It's a difficult issue.
Steve?
I'll leave it.
Just moving beyond the Steve Schiffers from City University. Just moving beyond the self-employed issue, which obviously could see the big gaps. I want to focus on some of the broad points of the presentations, which is basically people don't seem to respond to economic incentives because there are behavioral or information gaps. People don't have the confidence to make these decisions. They're not sure how important they are. And if they do, they're probably often confused about what they should do, and they go to the default position. And what I'm interested in is what sort of research has there really been done? Has there been enough research done on how people get information about pension provision, who provides it, and how accurate is it? And I think it's both information about schemes, but also the even deeper issue of financial capability and financial literacy, which the sort of 40% figure on people who aren't saving enough is broadly also the 40% figure of people often, depending on different measures, are seen to not have a low standard of financial capability, which is basically also lack of confidence. And on that point, one of the areas I'm concerned that we haven't really looked at very much at all is the role of the media in communicating or not communicating this, because from some of the research I've done, that's one of the main sources that people get their information. But I don't think we've really examined enough how that's communicated, whether it's communicated adequately. And I would say in comparison to the US, where the switch out of defined benefit schemes happened much earlier, there's a lot more press information, publication, and therefore awareness of the importance of this issue and making these decisions early.
I'll be honest, I don't know the research in depth on how people get information about their pensions. Maybe my colleagues might want to step in. I think that there's a kind of tension. So some of this work can be a bit pessimistic in a sense about the ability for people to make decisions, good decisions. And we know that there are low rates of financial literacy and things like that. But there still is a tension that when you do look over people's lives, particularly of the generation who are currently early retirement or just approaching retirement, despite all the worries about people not being financially literacy, not participating enough, a lot of this generation has actually accumulated a lot of wealth in a way that puts them in a pretty good place for retirement, and indeed not only in absolute terms, but compared to what you think might be a good thing to have done given their incomes over their lives. So there really is a tension in economics and indeed in the kind of literature about, at the micro level, people not being able to be flexible and poor literacy, but when you step back, at least for people around retirement now, the picture looking a lot more optimistic at that, the big scale than you might expect given this. I'm not sure we really understand that at the moment, but it's something that our colleagues, Rowena Crawford, who now used to be our colleague, and James Banks, who've written specifically on this tension, and I think we broadly need to do more thinking about that. IFS and in this kind of area. I don't know, any of my colleagues have
And a couple of observations. One is on the provision of information, it's quite hard to do well, and I think the evidence shows that if you want to get people to respond by changing their behaviour, you need to provide a lot of information. You can't just do like the one-off presentation. You're talking about repeat engagement with people, and it's quite intensive. I think another observation, Tom mentioned the fact that the DWP work last week showed that roughly 40% of people under saving against a certain benchmark. Actually, that percentage was much higher amongst higher earners than lower earners, which I think is a function of having a state pension that's higher now than it has been for quite some time, and that provides a level of income for perhaps some low earners that isn't so bad. But of course, without an earnings-related state element, without defined benefit private sector pensions, it becomes much more challenging for middle and high earners to get a decent replacement rate. So their evidence suggests if it is a replacement rate you're looking for, it's actually perhaps, so it's not necessarily the most vulnerable in society who are falling short of that benchmark, it's actually the other end.
Yeah, and I guess in a way the information is one issue, but when we are in this kind of environment where where we have so much lack of engagement, then maybe the role of policy in a way is to try and think about how do we protect people when there's no engagement, and how do we make sure that they don't get kind of very bad outcomes in retirement without engagement. And I think that's kind of, you need to have that sorted out first, and then you can start trying to build up, okay, how do we get more engagement and actually get information out to people.
Gentleman at the back here. Oh, sorry. We'll go with Mary, yeah.
Right. I just wanted to say, to ask really, whether you have any indicators as to whether the self-employed are saving into tax-assisted savings schemes as opposed to pensions, because actually they get the equal amount out, just at different times. They get it. Sorry. They get different amounts. They get the same amount out. They just pay the tax at a different time. Okay, because they'll get the money out at the end when their pension is tax-free. And the second thing is that I would be horrified if you had a change at when people move onto the higher rate tax system, because what that will do is simply massively increase the quantity of tax relief that's going to higher earners who actually need the tax relief less than the people at the bottom, and a much better way of using public money would be to increase the amount of support that's going to lower earners, putting money into pension schemes for when they come to pension age and they have a much smaller pension.
Can I take the latter first, given I talked about it?
Yeah.
I mean, so I definitely am not proposing employer default contributions to go up at that point, at the moment, at least. Haven't thought about that. But there is a case for higher earners to contribute more, and we have defaults which are very sticky. Once we introduce a set of things with lots of defaults, we should think about whether they are the right ones. People who contribute more are going to get relief because they pay more tax, and they will pay more tax on it coming out. And now if we think that we have a tax system that provides too much incentive for tax relief, then my personal opinion is we should do something about the tax system. And indeed it's the case that, as Carl said, that the DWP work says that it is in terms of adequacy, against these kind of standard benchmarks, it's not the case that people on these level of incomes are completely sorted. So, people pay tax later. I agree. I don't totally disagree about the system of pension taxation, but I don't think it just because you've got a kind of taxation of pensions that you don't necessarily like doesn't mean you shouldn't think about people on this level of earnings and what the right default for people putting their own money into pensions is. That's. I think there is a realm of reasonable disagreement in this, though. That's my thoughts at the moment. Hayley is going to know more about the other assets and savings of the self-employed.
Yeah, so we haven't, in the data that we have, it's a bit more difficult to say much about the kind of other wealth or saving that the self-employed are doing, but we have looked at this using kind of survey data in the past. And actually what we found was that even if you're looking at saving in ISAs or sort of savings accounts or anything, even saving in those has fallen among the self-employed over this period. So yeah, it doesn't look like there's now been a huge increase in saving in ISAs. The self-employed are a bit more likely to have more of their wealth held in property. And those, of course, we know that property values have gone up. But the patterns that we've seen among the self-employed and the employees are very similar. So again, it doesn't really explain why there's been this kind of split in, even before automatic enrollment, in the saving rates between employees and self-employed.
And in fact, the point about, I mean, the lifetime individual savings account actually looks like the kind of vehicle that should be pretty attractive to the self-employed. If you're a basic rate tax paying self-employed person, you're not getting an employer contribution, as we've discussed. Actually, the deal being offered to you by a LISA is pretty good compared to the alternative of locking your money up in a pension. It is a bit surprising that the self-employed have not taken those up in much greater numbers. As I say,
better than a pension. I speak as an expert.
so even better, apparently, even better. Okay, and we'll go to the gentleman at the back now.
Thank you very much. My name's Ian Bright. I'm not associated with any institution. If I'm ready, may I ask two quick questions? Firstly, on the self-employed, have you been able in your data set to identify those who have professional advice and those who don't? I would think that if a tax account has been filed by an accountant, for example, I have professional advice on whether behaviour is different on that. The second question, if I might be so bold, is to do with the gender gap. Many of the decisions which are made as joint in families, males, females, or whatever family situations are involved. Have you been able to have a look at the total wealth of the household under the pension contributions and see how that affects the gender gap rather than just the male and female? So, for example, women never married against men never married is against household structures. Thank you.
Yeah, so very quickly to the first question. So in the tax data, we can observe if someone's tax return was filled in by an agent, but we don't know who that agent was. So it could be anyone. It could be a professional advisor, but it could be your family member or so on. So yeah, we haven't been able to look at that question specifically. We'd have to kind of go into the sort of survey data for that, where then we have issues of sample size and so on. But yeah, unfortunately, haven't been able to look at that in this particular piece of work.
Yeah, regarding the gender pension gap and the effect of the household, we didn't look at that in this report necessarily, but I think it is a very fair point. I think something we did look at actually in the report that Jonathan was talking about is, as Jonathan sort of mentioned, what happens when your partner starts working, there's more household income available. Does that change your pension saving decisions, which you might think it would if you're making sort of decisions as a household? And we don't really see much effect of this, and we look at this separately by gender as well. And it doesn't seem to be the case that, for example, women or men, when their partner starts working or stops working, they make big changes in their pension decision there. And I think there's some evidence from the US, for example, that people don't seem to be making these household decisions in a really way that seems to be very joint and seems to be sort of as if they're trying to take advantage of all the incentives available. So I think it's definitely something we can do further work on, but it's not clear that people are making these really joint rational decisions at all points.
I mean, specifically on this piece of work that includes an IFS research fellow, Cormac O'Dean, the thing that they do is they look at the match incentives of men and broadly men and women in couples, and they see some people putting in more. So imagine that you match up to 6%, right, in a scheme in America, and they see some couples where they both get these match offers, but one puts in like 10% and is getting unmatched, and the other one is putting in only like 4% and is leaving match on the table. So they could reallocate, but they don't. So that's the specific piece of work Lawrence talks about there.
Yeah. And the other thing you do, Lawrence, is you look at what happens to fathers as compared to mothers after the arrival of first child, right? That's kind of instructive.
Yes, that's a good point. So what we see actually when we look at just own, so we don't see employer contributions for this, but when we look at people, fathers and mothers, or prospective fathers and mothers, a couple of years before they have their first child, they've got fairly similar pension contributions. And then when we look at them 8 years later, so 6 years after the birth of the first child, the men's own contribution is about double what the women is contributing. So there's a real gap opening up then. And most of that is due to the gap in like employment rates or hours worked or pay that opens up there. Some of it, as Jonathan said, is due to different decisions made controlling for these sort of things as well, though.
Okay, I think there's one more. We'll have one more question here. Yeah.
Hi, 18 Young, Centre for Ageing Better. Thanks, lots to think about there. I suppose a couple of comments. Jonathan, you were talking about moving from owning to renting as being a sort of a trigger, a point at which people could increase their contributions. I was just sort of thinking about the fact that private renting rates of private renting are increasing at all ages, and so that's just a sort of thing that trigger, even if it's minor, will be removed. And we know that renters are more likely to be living in poverty. So that sort of trend over the long term could have an impact, couldn't it, on your pensions? That was one thing. I was also wondering if you had any reflections on sort of all, the data that's coming out. We've got all this huge number of economically inactive people who've fallen out of the workforce, many because of ill health. This is particularly an issue for the poor, for the poorest and for the poorest women. And sort of so over a longer period of time, we could see the pay gap actually increase. If you've got sort of women having to fall out of work at younger ages because of disability or long-term health conditions. I just wonder if you have any reflections on those points.
Yeah, okay. So I hope I didn't say that when they went from owning to renting that they should be...
The other way around.
Well, so I think two things. One is when you pay your mortgage off, that's really when your kind of consumption needs change. So that's that thing. But I really do think that the renting issue is a big one. I mean, there are projections from DWP about the number of people, I think above state pension age, who might be getting housing benefit. The number of people in their 50s approaching kind of retirement ages who live in private rented sectors looks like it's going up generation to generation. These are kind of, I don't have the answer for you about what there should be done about that, but it is a real concern if you hit retirement with substantial housing costs when, most planning for retirement is thinking about you either have a mortgage paid off or potentially you're in social housing and covered entirely by housing benefit. The economic inactive, so, I mean, my understanding of the data is that it's been fairly similar kind of flow out of work and into economic inactivity for both men and women, not a big gender angle on that. Of course, women now face the same state pension age as men, but clearly a lot higher than the women's one was just over a decade ago, and they've got longer to wait than previous women had, or the same as men. My understanding of the health issue is that we have on a variety of metrics, poorer health, high disability roles, higher self-reports of poor health, and that what my understanding of what seems to be happening is that people already out of work in their 50s seem to be getting even sicker. Now, that's bad for them and their welfare, and it's also bad if we think that it's going to make that even harder for people to go back into work. But I think there's quite a lot of my understanding is there's quite a lot of moving parts on that particular issue.
Thank you very much. So we've reached time. Just finally, I want to say a big thank you to Jonathan and Heidi and Lawrence for great presentations, and to thank you to Tom for joining us from Sheffield, and thanks to all of you for coming along. Thank you.